Welcome. Let's talk about risk management, a topic that is absolutely critical for the bar exam. We're going to go way beyond just memorizing definitions. What the exam really tests is your ability to think like senior leadership, using a company-wide strategy to make smart decisions that create and protect value. The whole game is about connecting risk directly to strategy. So let's get right into it.
So here's our game plan. We'll start by linking risk to big-picture strategic decisions. Then, we'll unpack the all-important enterprise risk management framework. You'll hear it called ERM. After that, we'll dig into how you actually respond to risk, see how it hits a company's financials and KPIs, and finally, we'll zoom out for that crucial, broader strategic view.
Okay, first up, for the bar exam, you have got to shift your mindset. Risk management is not some boring compliance task or a checklist you just tick off. No way. It's woven into the fabric of every single major strategic decision. It's really about fueling growth, not just about stopping bad things from happening.
This right here, this is the million-dollar question, isn't it? Every single chance to grow, whether it's launching a new product, buying another company, or moving into a new country, it all comes with a big dose of uncertainty. The whole point of enterprise risk management is to give leadership the toolkit to answer this question, not with a gut feeling, but with a smart, consistent approach.
You know, to make this stuff really stick and show you exactly what this looks like on the exam, we're going to follow a case study. We'll meet a company called ClearPoint Foods, and we'll watch over their shoulder as they think through a major strategic move. This is going to let us see the cause and effect of their decisions in real time. First things first, let's get our bearings. ClearPoint starts out with a current ratio of 2.0. Now, you know this is a key measure of liquidity. It tells us they have $2 in current assets for every $1 of current liabilities they owe. A 2.0 ratio? That's pretty strong. It signals a healthy working capital position and a nice cushion to pay their bills.
Now let's check out their leverage. Their debt-to-equity ratio is 0.8. This gives us a peek into how the company is financed. It shows they're using more of the owner's money, equity, than borrowed money, debt. A ratio under 1.0 is generally a good sign. It points to financial strength and lower risk. So, this is our starting line.
And here's the curveball. Management spots a huge opportunity to grow by expanding into a new foreign market. Awesome. But to fund it, they're planning to take on $150,000 in new debt. And here are the key words. It's short-term, and it has a variable interest rate. This one move is about to open up a whole new world of risks.
So how in the world does management tackle a decision like this? Well, they don't just wing it. They use a structured, repeatable process called the Enterprise Risk Management Framework, or ERM. Let's pull back the curtain and see what that's all about. So this is the official definition from COSO, but here's the core idea in plain English. ERM is there to help a company handle all the uncertainty that comes with trying to achieve its goals. It is not about getting rid of all risk. That's totally impossible. It's about understanding your risks, deciding which ones are worth taking to reach your goals, and making sure you're operating within your company's risk appetite. The COSO framework gives us this really logical flow. First, you've got to identify what could possibly go wrong or right that could affect the company. Then you assess those things. How likely are they to happen, and what's the impact if they do? Based on that, you choose how to respond. And finally, and this is key, it's not a one-and-done deal. You have to constantly monitor those risks and report on them because, hey, the world never stops changing. Okay, listen up, because for the exam, this is the mental model you need to have locked in. For any scenario they throw at you, just walk through these steps. First, what kind of risk are we even talking about? Is it financial, operational, strategic? Second, who gets hit by this? Then you crunch the numbers. You calculate the impact on key ratios. From there, you brainstorm how management could respond. And finally, and this is where you scored the big points, you interpret what it all means for the company's grand strategy. This brings us to a super important part of the whole process. You know, identifying and assessing risk, that's just the analysis part. The real work, the real management is in the response. You have to make a choice. What are we actually going to do about this risk? So, management has 4 main plays in its playbook. They can avoid the risk entirely. For ClearPoint, that would mean just saying, nope, we're not expanding. Simple. They can reduce the risk, maybe by putting in better internal controls. They can share or transfer it. That's exactly what you do when you buy insurance or use a financial tool like a hedge. Or finally, they can just accept it, deciding that, you know what, the potential reward is worth the risk and we can live with it.
And remember, risk isn't just about the numbers on a spreadsheet. Environmental, social, and governance (ESG) factors are a huge source of risk for companies today. Think about it. A changing climate could mess up your supply chain. That's an operational risk. A story about bad labor practices can destroy your brand's reputation. And these days, banks might not even want to lend you money if your environmental record is poor. It shows just how tangled up all these risks are and how they hit the bottom line and long-term strategy.
All right, theory time is officially over. Let's apply this thinking framework directly to our ClearPoint Foods scenario. We're going to walk through this analysis step by step and see exactly how this one strategic decision sends ripples through their key performance indicators.
So, step 1, identify the risks. By deciding to expand abroad using variable rate debt, ClearPoint is suddenly facing a bunch of new threats. There's currency risk because their new sales will be in a foreign currency, but they might have to pay back their debt in dollars. There's interest rate risk from that loan. If rates go up, their payments go up. There's demand risk. What if nobody in this new country wants to buy their stuff? Taking on short-term debt automatically creates liquidity risk. And of course, there's regulatory and ESG risk from operating under a whole new set of laws.
Now, let's measure the hit to their working capital. Their current assets are still $600,000, but their current liabilities just shot up to $450,000 because of that new loan. So their new current ratio, it drops from that strong 2.0 all the way down to 1.33. That is a pretty serious drop in their liquidity, and it means their safety cushion for paying bills just got a lot smaller.
And at the very same time, let's look at their leverage. Their debt ballooned from $400,000 to $550,000, while their equity stayed put at $500,000. This shoves their debt-to-equity ratio from a safe 0.8 all the way up to 1.1. Now, for the first time, the company owes more than it's worth in equity. This is a fundamental increase in their financial risk.
So this is the SWOT moment. It's all about understanding the story that these numbers are telling us. Weaker liquidity means they have less wiggle room. Increased financial risk means if their profits take a dip, they could have real trouble paying their debt. That new debt means higher interest payments, which puts direct pressure on their profit margins. And all of this together just reduces their flexibility. It might be harder to get another loan, and they could even be in danger of breaking the rules, the covenants, on their existing loans.
Okay, so now that management sees these red flags, they can start to build a game plan. To handle those financial market risks, they could use derivatives to hedge their currency and interest rate exposure. That's a classic share response. To fight back against the weak liquidity, they could try to reduce the risk by getting better at managing their working capital, like collecting cash from customers faster. They could also reduce the risk by doing the expansion in smaller phases. And of course, the avoid option is always on the table. Just cancel the whole thing.
All right, finally, no single decision ever happens in a bubble. A fantastic way to put all these pieces together and make that final call is to see how it fits into the company's overall strategic picture. And for that, we can pull out a classic tool, a SWOT analysis. A SWOT analysis helps frame the decision by looking at things from 4 different angles. An internal strength could be ClearPoint's great brand reputation, which might help them succeed. But an internal weakness is that they have zero experience in this new market. The external opportunity is huge, a whole new market to grow in. But the external threats we've already talked about, like shaky currencies or politics, are very real. Seeing it all laid out like this helps management make a balanced, informed decision. And just a quick note, on the exam, the numbers might not be this nice and round, but the logic you apply is exactly the same. If you take one thing away today, let it be this. The whole point of ERM is not to build a company that takes 0 risks. The goal is to make sure the risks you do take are the right risks, the ones that line up with your strategy and give you a good shot at creating value. It's all a balancing act.
And I'll leave you with this final thought to chew on. We've spent all this time analyzing the risks of doing something new. But what about the risk of not doing it? The risk of just standing still while your competitors race ahead? The risk of missing out on a massive opportunity? A really good ERM process helps leaders look at all the paths, including the path of doing nothing, to make the best possible call for the company's future.